A 1% fee does not sound huge until you compound it for 30 years. I want you to imagine starting a small business. A guy walks in off the street, provides $0 in startup capital, does absolutely none of the daily labour, and takes 0% of the bankruptcy risk. However, he demands 30% of your lifetime profits forever. You would laugh him right out of the room. Yet, if you have a traditional wealth manager, a standard mutual fund portfolio, and a hands-off approach, this is the exact mathematical reality of your retirement account. Today, we are going to look at the brutal math behind the wealth advisory fee. We are going to stop looking at percentages, because percentages are abstractions designed to make massive numbers look incredibly small. We are going to look at advisory fees, mutual fund expenses, and platform costs in absolute dollars. Once you see the true dollar amount being siphoned out of your passive portfolio over a lifetime, you will finally understand why the financial services industry is so consistently profitable. Before we tear down the math, if you appreciate a strictly numbers-driven approach to wealth building without the usual internet hype, subscribing to the channel is the best return on investment you can make with your time right now. The financial services industry has successfully propagated a deeply ingrained societal myth. That myth tells you from day one that you need a professional to manage your wealth, and that a 1% fee is an incredibly small price to pay for peace of mind. We are taught to view this fee as a marginal tax on our gains. If the market goes up 8% and we pay 1%, we assume we just keep 7%. It sounds harmless, almost like paying a sales tax at the grocery store. But it is fundamentally not a tax on your gains. It is an annual confiscation of your total accumulated capital. Intelligent, highly educated professionals willingly surrender massive portions of their wealth because they have been conditioned to accept this arrangement. To truly understand why we fall for this mathematical trap, we have to look back at the historical shift in how Americans are forced to retire. Over the last 40 years, the burden of retirement shifted dramatically from the defined benefit pension plan to the defined contribution plan, which you know as the 401k or the IRA. The responsibility moved entirely from institutional actuaries, who literally do complex mathematics for a living, to the mathematically untrained individual worker. Suddenly, regular people were faced with the terrifying prospect of managing their own capital in a volatile market and potentially outliving their money. Naturally, they sought out experts to save them from this uncertainty. Wall Street capitalized on this widespread fear by creating a massive, highly profitable asymmetry of information. They knew you were scared, and they built an industry perfectly designed to charge you a premium. The industry took basic, straightforward index investing and immediately wrapped it in layers of complex academic jargon. They started talking to retail investors about alpha generation, beta tracking, standard deviation, and modern portfolio theory. They created a towering language barrier that made retail investors feel entirely unqualified to manage their own money. This complexity was manufactured specifically to justify the ongoing assets under management fee model. When you sit in a leather chair and feel profoundly confused by the charts in front of you, you are more than happy to hand over 1% of your entire life savings to someone who sounds like they hold the mathematical secrets to the universe. But as we are about to see, the true cost of this manufactured confusion is absolutely staggering. The math reveals a completely different, much darker reality than those glossy quarterly brochures suggest. The peace of mind you are buying is actively shrinking your family wealth. If you think that 1% fee is just a tiny sliver of your pie, wait until you see what happens to the underlying math when we push this out over 30 years. Most people stop at the superficial percentage and end up losing hundreds of thousands of dollars without ever noticing. We are going to run the variables for a typical mid-career professional in the year 2026. Let us assume you have an initial portfolio balance of $250,000, perhaps sitting in a rollover account from a previous employer. You plan to contribute exactly $3,000 a month for the next 30 years. We will assume a gross market return of 7.5%, which is a highly realistic equivalent to the broad stock market. Now, here is where the trap snaps shut on the average investor. You rarely pay just 1% to the industry. The advertised rate is never the final bill. The true cost of a professionally managed portfolio is almost always layered into a hidden fee stack. First, you have the baseline wealth advisor fee, which is typically 1% of your total assets under management. Then, you have the underlying mutual fund or exchange-traded fund expense ratios. When an advisor puts you into an actively managed fund to justify their expertise, those internal fund fees can easily average 0.5%. Finally, you have platform fees, custodial charges, or trading spreads that add another 0.25% in drag. When you stack it all up, your total annual drag is not 1%. It is actually 1.75%. That difference might sound like pennies to the human brain, but in the realm of compounding interest, it is utterly devastating. It is the literal difference between achieving an early, comfortable retirement and being forced to work an extra decade. Let us look at scenario A, which we will call the hands-off investor, stuck in the 1.75% trap. We start with a gross market return of 7.5%, minus the 1.75% in total fees, leaving a net return of 5.75%. Over 30 years, the future value of that initial $250,000 grows to about $1.3 million. The future value of your monthly contributions grows to roughly $2.7 million. Your total out-of-pocket contribution over those 3 decades was $1.33 million. When you add it all up, your terminal wealth in scenario A is $4,060,702. To most people, $4 million sounds like a massive success story. You only feel rich until we look at the mathematical alternative. Now we look at scenario B, the DIY optimizer who uses a minimal fee structure and ignores the Wall Street noise. This investor builds a simple portfolio using core broad market funds from discount brokerages like Vanguard or Fidelity. Their total fee stack is just 0.05%. Therefore, their net return is 7.45%. Over the exact same 30 years, with the exact same initial balance and the exact same monthly contributions, their terminal wealth reaches $5,850,071. The mathematical difference between the two identical scenarios is $1,789,369. Let that absolute dollar amount sink in for a moment. The investor in scenario A did not pay 1.75%. They paid $1.78 million in hard, physical cash to be put into a standard 60-40 portfolio. Most people stop here and lose $1.7 million because they miss the opportunity cost trap. Here is the ultimate kick in the teeth regarding those numbers. In the first scenario, the gross portfolio generated over $4.5 million in total market gains. The financial industry extracted $1.78 million of those specific gains. You took 100% of the actual market risk. You provided 100% of the required capital. And yet, the financial industry siphoned off roughly 40% of your lifetime returns. Furthermore, these advisory fees are assessed on your total account balances, not your gains. If the stock market drops 15% in a given year, you suffer the entire 15% loss in wealth, and the advisor still deducts their 1% fee from your remaining battered balance. This mechanically exacerbates your sequence of returns risk. You pay them when you win, and you pay them when you lose. Why do intelligent people continue to make this mathematically disastrous choice? It all comes down to a potent cocktail of behavioral economics, starting with the denomination effect. Human brains evolved to understand basic linear progression. we are terrible at intuitively grasping exponential compounding. When a financial advisor sits across from you and says their fee is simply 1%, your brain automatically categorizes this alongside a 7% sales tax at the local store. It feels entirely negligible to your primitive survival instincts. The financial industry relies heavily on this percentage framing to survive. If advisors build their clients via monthly physical cash invoices, sending a $400 paper invoice every single month to a client with a $500,000 portfolio, the psychological pain of writing that check would cause an immediate mass exodus. Percentages keep the pain invisible. They extract the wealth directly from the account before you ever see it hit your checking balance. The next psychological trap keeping you poor is the principal agent problem, combined with extreme complexity bias. The traditional wealth manager is highly incentivized to gather your assets and keep you compliant within their ecosystem. They are not necessarily incentivized to maximize your terminal net worth. Their primary corporate directive is asset retention and fee generation. To justify their ongoing wealth tax, they often introduce completely unnecessary portfolio complexity. They might put you in 25 different mutual funds, each with their own 50-page prospectus, making your quarterly statements look incredibly sophisticated. You look at this tangled web of international and domestic investments and think you could never possibly manage this yourself. But the complexity is a feature of the sales pitch, not a mathematical requirement for good returns. Simplicity actually outperforms complexity over a 30-year timeline. But nobody gets paid 1% a year to tell you to buy a single index fund and go to sleep. Once you realize the complexity is a mirage, you face the next hurdle. Once your capital is transferred to an advisor, moving it requires navigating clunky proprietary platforms, getting medallion signature guarantees at a physical bank, and dealing with potential tax hits. Investors look at this friction and experience severe status quo bias. They pay a loyalty tax because the immediate administrative headache of moving their money feels physically worse than the invisible long-term erosion of their wealth. Add in loss aversion, where advisors sell the illusion of downside market protection, and you have a perfect psychological storm. Investors gladly pay the fee as an emotional insurance policy against their own financial ignorance, entirely oblivious to the fact that the premium for this insurance guarantees mathematical underperformance. The data unequivocally proves that active managers do not consistently beat the market, nor do they prevent losses during major macroeconomic drawdowns. This is where conventional wisdom tells you to trust the experts, but I am going to tell you to completely fire them. If you are struggling to picture how damaging this is, imagine walking into a grocery store to buy a $4 gallon of milk. But instead of charging you $4 at the register, the cashier demands 1% of your entire checking account balance before you can leave the store. That is exactly how assets under management fees work. They aggressively tax your existing capital, not the transaction or the specific service provided. Think of it like a drag parachute on a race car. High income is the engine of your financial life, but net worth is the actual vehicle. A 1.5% fee stack is a parachute deployed out the back. No matter how much horsepower you add to the engine, that drag parachute increases its resistance exponentially the faster you try to go. We can see this drag clearly using a fee-adjusted version of the Rule of 72. This rule divides 72 by your interest rate to tell you exactly how many years it takes your money to double in value. At a gross market return of 7.5%, your money doubles every 9.6 years. But at a net return of 5.75%, after the industry takes their cut, it takes 12.5 years to double. Over a 30-year investing lifespan, the fee robs you of an entire doubling cycle. Since the last doubling cycle is always the largest by an astronomical margin, losing it literally destroys your chance at generational wealth. You do not just lose the money they took, you lose decades of compound growth on the money they took. You are paying a premium price for mathematically guaranteed underperformance. It is the worst trade in modern finance. We will get to the exact portfolio allocation in a minute, but first we need to fix the leak. You must aggressively audit, extract, and automate your portfolio architecture. Step 1 of this protocol is the Total Wealth Confiscation Audit. Stop looking at your glossy prospectus. Log into your brokerage, locate the year-to-date fee deductions, and run a very simple formula. Multiply your total portfolio value by your advisory fee, then add your total portfolio value multiplied by your weighted average expense ratio. Look at that final absolute dollar amount on the screen. Ask yourself honestly, if I had to pay this exact amount in physical cash today out of my checking account, did I receive equivalent value in tax optimization or estate planning this year? For 99% of you, the answer is a resounding no. You received zero value for that cash. It is time to move to step 2. I know that extracting yourself from a complex financial arrangement can feel completely overwhelming, which is exactly why we built Cash Class. Cash Class is the official Tom Talks Money web app, and it is the ultimate bridge between learning this math on YouTube and actually applying it to your own life safely. We designed it with a strict privacy-first angle. There are absolutely no risky bank logins required. You simply download your statements and upload your CSV files directly to the web platform. It instantly helps you visualize your cash flow and expose your hidden fee structures in absolute dollars, not confusing percentages. Plus, it includes a totally free Budgeting 101 course to get your baseline fundamentals locked in. You can click the link at the very top of the description to start your 14-day free trial on the web right now. It is the perfect analytical tool to help you navigate this transition with total confidence. Step 2 of the protocol is the core and satellite indexing shift. You need to confidently strip away all layers of active management. Transfer your assets in kind to avoid unnecessary capital gains taxes, moving them to a reliable discount brokerage like Fidelity, Vanguard, or Schwab. Once the capital is secured, you want to implement a strict 3-fund protocol. Allocate your capital entirely to broad market index exchange-traded funds. You only need one for total US stock, one for total international stock, and one for total bond market exposure. By doing this, your new total expense ratio must be mathematically capped below 0.10%. You are instantly reclaiming over 90% of the fees you were previously bleeding out to the industry. You do not need 25 mutual funds to be diversified. You just need 3 index funds that own the entire global economy. Step 3 is the flat fee fiduciary pivot. If you have a truly complex situation, like a massive business sale or a multi-state inheritance, you absolutely do need professional advice. But the secret is that you buy it wholesale, not via a percentage tax. Fire the asset management advisor and hire an advice-only fiduciary, like a CPA or a CFP, who charges by the hour or a flat project fee. Paying a flat $2,500 annually for a comprehensive checkup on a $1 million portfolio equates to a 0.25% fee. And that fee actually decreases in percentage as your wealth grows. Finally, step 4 is to automate everything. Set up automated bi-weekly purchasing rules on your new brokerage platform. Set the rules, delete the app from your phone, and review it only on December 31st. You just replicated the psychological value of an advisor for exactly $0. When you stop viewing fees as a minor percentage and start viewing them as absolute dollars violently extracted from your terminal net worth, your entire financial worldview changes. You stop paying a massive loyalty tax to institutions that do not care about you, and you start optimizing the math for your own family's future. It is a fundamental shift from being a passive consumer of financial products to an active architect of your own freedom. If you found this rigorous breakdown valuable and you want to support this kind of independent financial research, consider clicking the Join button below the video to become one of the optimizers. Channel members get priority replies from me in the comments, and you get custom sketch badges next to your name. Your support keeps this channel entirely focused on the raw data, completely free from sketchy product pictures. The math behind compound fees is undeniably brutal, but staying trapped in the system is entirely a choice you make every single day. Now it is your turn to do the work. I want to hear from you down below. Have you run the numbers on your own fee stack yet? Did you discover a hidden expense ratio that shocked you? Drop your specific findings in the comments below. Consider it a massive open-source peer review session. Let us gather the data as a community and see just how much capital we are reclaiming from the financial industry this year. I read every single comment, and I learn just as much from your experiences as you do from these videos. As always, do not just trust the narrative I present here. Run the hard numbers for yourself. Thanks for watching, and I will see you in the next one.